It's happening right now. As you listen to this, the United States financial system has quietly crossed a line that mathematically guarantees a crisis. We aren't approaching the cliff anymore. We are over the edge. And the only thing keeping us suspended in midair is momentum. Think about the last time you felt truly secure about the economy. Maybe 20 years ago. Back then, debt was a political talking point. It was something politicians argued about on debate stages. Today, it is a mathematical inevitability. We have entered what macroeconomists call a debt death spiral. It's a feedback loop. Higher interest rates lead to larger deficits. Larger deficits require more borrowing. More borrowing scares off buyers, which pushes rates even higher. And round it goes faster and faster until the gears shear off. This isn't hyperbole. This is arithmetic. And for the first time in American history, the cost of yesterday's choices is now more expensive than the cost of defending the nation today. Let that sink in. We are paying more to service our past than we are to defend our future. You need to understand the scale of what just happened. For decades, the United States Department of Defense was the undisputed heavyweight champion of federal spending. Aircraft carriers, fighter jets, millions of personnel, bases in 80 countries. It was the biggest line item on the receipt. But in fiscal year 2025, that changed. According to the latest projections from the Congressional Budget Office and the Committee for a Responsible Federal Budget, net interest costs on the national debt have hit approximately $970 billion. $970 billion. Compare that to the Pentagon. Defense outlays are sitting roughly between $900 and $950 billion. Medicare? About the same. We have officially reached the point where our interest bill, money that buys us absolutely nothing, no roads, no schools, no tanks, just the privilege of not defaulting, is now the single largest expense in the discretionary budget. How did we get here so fast? Go back to 1980, the era of Paul Volcker. Inflation was raging, rates were sky high. Back then, interest payments consumed about 9 or 10 cents of every tax dollar the government collected. It was painful, but manageable. Fast forward to the 2008 financial crisis. Rates crashed to zero, so even though we borrowed trillions to bail out the banks, the cost to service that debt stayed low, around 8 or 9% of federal receipts. But today, we're looking at 18 to 19% of federal revenue going straight to interest. Roughly 1 out of every $5 you pay in taxes vanishes. It leaves the Treasury the moment it arrives, wired to bondholders in Tokyo, London, and Wall Street just to keep the lights on. We have effectively doubled the burden compared to the crises of 1980 and 2008. And here is the terrifying part of that analogy. If Washington took every single penny of individual income tax receipts, everything withheld from your paycheck, and tried to pay off the interest, they would barely cover it. We are borrowing to pay the interest on the money we borrowed. This is the definition of a Ponzi scheme. The only difference is this one has an army. But numbers like billions and trillions numb the brain. They are too big. They sound like abstract noise. So let's look at the velocity, the speed at which the ice is cracking beneath our feet. The current national debt is roughly $38.4 trillion. 38 trillion. But the total number isn't the story. The story is how fast that number is growing. Go back 10 years. Around 2014 or 2015, the deficit was maybe $400 or $500 billion a year. Back then, it took the government 2, maybe 3 years to add a single $1 trillion to the debt. We thought that was reckless. Today, Washington burns through $1 trillion in debt every 8 to 10 months. Think about that timeline. Every 240 to 300 days, the U.S. government adds another $1 trillion to the pile. If you spent $1 million every single day, literally burning $1 million of cash every morning when you woke up, it would take you about 2,740 years to spend $1 trillion. The U.S. government does that essentially every year. And because of this spending, our debt to GDP ratio, the true measure of a country's financial health, is screaming red. We are sitting at roughly 124% of GDP. We have seen this number exactly one time before, World War II. In the mid-1940s, we hit about 113%. But there's a massive critical difference between 1945 and 2025. In 1945, we had just won a global war. We were the manufacturing engine of the world. We had a baby boom on the horizon, a massive demographic wave of young workers ready to pay taxes and drive growth. We grew our way out of the debt. Today, we have the wartime debt. Without the war, we have an aging population, not a baby boom. We have shrinking productivity growth, not a manufacturing explosion. We have recreated the financial conditions of a world war purely through peacetime mismanagement and entitlement promises. And the world is noticing. This is where the story shifts from bad domestic policy to geopolitical crisis. For decades, we relied on a simple arrangement. We printed dollars, and the world bought our debt. It was the exorbitant privilege. China and Japan were the reliable buyers. They exported goods to us, took our dollars, and recycled them back into U.S. treasuries. It kept their currencies low and our interest rates low. It was a symbiotic loop. That loop is broken. Look at the Treasury International Capital data, the TIC flows. This is the ledger of who owns America. China has been quietly, methodically dumping U.S. debt. In 2013, they held nearly $1.3 trillion in U.S. treasuries. They were our banker. Today, that number has crashed below 1 trillion. It's sitting somewhere around 780 to 800 billion. In just the last 3 years, 2022, 2023, 2024, China offloaded over $280 billion of U.S. debt. Sure, you might see a small blip here or there where they buy a little, like early 2025, but the trend line is a cliff. They are getting out. They know what is coming and they are de-risking. Japan is still there, holding about 1.1 trillion, but they have their own currency crisis to manage. They can't absorb the tsunami of new debt we are issuing. So if China is selling and Japan is tapped out and the US government needs to issue $1 trillion of new debt every 9 months, who is buying? You are. Domestic buyers, US households, mutual funds, pension funds, and inevitably the Federal Reserve. When foreign demand dries up, the government has to look inward. They have to extract that capital from the domestic economy, or the Fed has to print the money to buy the bonds. That is what monetization means. It's a polite word for currency debasement, and it means your dollars are being diluted to pay for the government's inability to balance a checkbook. And the cost of this debt isn't just a number on a screen in Washington. It is bleeding into the real economy. A few years ago, the average interest rate on government debt was under 2%. It was free money. But the Fed hiked rates to fight inflation, and now, as old cheap bonds mature, they are being refinanced at much higher rates. The average rate on marketable Treasury debt has climbed to around 3.35%. That might sound low compared to your mortgage, but on $38 trillion, that jump is catastrophic. It is why the interest payment doubled in 3 years. It is why we are paying defense-sized money just to stand still. And here's the kicker. That $38 trillion number, that's just the cover charge. That's just the debt we admit to. If you look at the unfunded liabilities, the promises Washington has made for Social Security and Medicare that they have zero money set aside for, the picture goes from grim to apocalyptic. The Wharton budget model, the Social Security trustees, pick your source. When you add up the implicit obligations, we aren't 38 trillion in the hole. We are over $100 trillion in the hole. Let's make this personal. Let's bring it down to your kitchen table. If you divide the current official debt by every man, woman, and child in America, you owe about $110,000. That's your share. Born today, you owe $100,000. But babies don't pay taxes. You do. If you look at the debt per taxpayer, the number is staggering. It is somewhere between $280,000 and $320,000. Imagine a mortgage for a house you don't own, that you can never sell, and that you never signed up for. That is your share of the national debt. If you're a family of 4 with 2 working parents, your household is effectively on the hook for over $500,000 of federal mismanagement. And that is before you pay your actual mortgage, your car note, or your credit card bill. This is the state of the union. A debt spiral accelerating, foreign creditors fleeing, interest payments eclipsing our ability to defend ourselves, and a bill that is being quietly passed down to you, your children, and your savings account. But why? Why does the system work this way? Why can't they just stop spending? To understand that, we have to look under the hood. We have to look at the plumbing of the financial system. Because this isn't just incompetence, it's design. The system requires debt to function. And that brings us to the players who actually benefit from this chaos. The whales, the banks, the algorithms, they built it this way. You see, the modern global economy isn't designed like a household budget. It doesn't function on the principle of earn, then spend. It functions on the principle of borrow, then grow. In this system, debt isn't just a byproduct of spending. Debt is the actual fuel. Every dollar in your pocket, take it out and look at it, is a Federal Reserve note. It is a liability of the central bank. It is, by definition, a unit of debt. For money to exist in this system, debt must be created. If the government actually paid off the national debt, if they miraculously brought that $38 trillion down to zero, the money supply would contract so violently that it would trigger a deflationary depression that would make the 1930s look like a picnic. The system requires the debt to expand. It needs the monster to get bigger just to stay alive. That is why the spending won't stop. It's not just that politicians are addicted to buying votes, though they are. It's that the banking system, the plumbing of the entire world, relies on U.S. Treasury bonds as the supreme form of collateral. Think of U.S. Treasuries, that government debt, as the foundation of a skyscraper. Every other asset in the world, stocks, real estate, corporate bonds, derivatives, is built on top of that foundation. The banks use these treasuries to borrow cash overnight in what's called the repo market. It's the oil that keeps the engine from seizing up. If the U.S. stops issuing debt, or if the world loses faith in that debt, the collateral becomes worthless. The foundation cracks, the skyscraper sways. So the Federal Reserve has a dual mandate. They tell you it's maximum employment and stable prices. That's the marketing brochure. Their real mandate is to keep the sovereign debt market functioning. This brings us to the whales. The whales are the institutional giants: BlackRock, Vanguard, sovereign wealth funds of nations like Norway or Saudi Arabia. They aren't day trading on an app like you might be. They are moving tectonic plates, and they understand the game better than anyone. They know that the government has only two choices when faced with this level of debt: default or debase. Default means simply not paying. Telling bondholders, sorry, we're broke. For the United States, the center of the global financial order, that is suicide. It's nuclear winter. It stops global trade instantly. So that option is off the table. That leaves option 2, debase. Inflation, financial repression. This is the mechanism. The government keeps spending. The Fed eventually steps in, even if they pause for a while, and buys the debt that the Chinese and Japanese won't buy. They print new dollars to buy old debt. This floods the system with liquidity. It makes the GDP number look higher in nominal terms. It makes the debt seem smaller relative to the economy, not because the debt went down, but because the money became worth less. The whales know this. They aren't scared of the debt number. They are positioning themselves for the response to the debt number. They know the dollar has to be sacrificed to save the system. And then you have the algorithms. In the old days, you had floor traders shouting in Chicago, humans making decisions based on fear and greed. Today, 70 to 80% of volume is driven by high-frequency trading algorithms. These are mathematical predators. They read the headlines, CPI prints hot, debt ceiling standoff, and they react in microseconds. Why does this matter to you? Because these algorithms exacerbate the moves. They create flash crashes and massive volatility spikes. They are programmed to hunt for liquidity. When you panic and sell because you see a scary headline, the algorithm is on the other side of that trade, buying your assets at a discount. They thrive on the noise. They feed on the panic that the media generates. And speaking of panic, let's talk about your brain. The most dangerous element in this entire equation isn't the Federal Reserve. It isn't the algorithm. It is human psychology. Specifically, a psychological phenomenon known as normalcy bias. Normalcy bias is the refusal to plan for a disaster that has never happened before. It's the voice in your head that says, well, the US has always been the superpower. The dollar has always been the reserve currency. Things have been fine for 40 years, so they'll be fine for 40 more. It is a survival mechanism. It keeps us from going crazy. But in financial markets, it is lethal. It's the reason people stayed in the stock market in 1929, even as the warnings flashed. It's the reason people bought third and fourth houses in 2007, right before the subprime collapse. We extrapolate the present into the future. We assume the trend is permanent, but history, Economy Decoded, that we talk about on this channel, shows us that trends always break. The Portuguese real, the Spanish real, the Dutch guilder, the French franc, the British pound sterling, all of them were once the only currency that mattered. All of them were as good as gold, and all of them eventually lost that status due to excessive debt and currency debasement. The average lifespan of a global reserve currency is roughly 90 to 100 years. The US dollar took the crown in 1944 at Bretton Woods. Do the math. We are right in that danger zone. The boiling frog metaphor is a cliche, but cliches are cliches because they are true. We are the frogs. The water has been warming up since 1971 when Nixon took us off the gold standard. It got hotter in 2008 with quantitative easing. It started bubbling in 2020 with the pandemic stimulus. And now, with interest payments exceeding defense spending, the water is rolling. Most people are just sitting there enjoying the warmth, arguing about politics, completely unaware that the chemistry of the water has changed. They are holding cash, dollars, thinking it is a safe haven. And this leads us directly to the solution, the pivot. This is where I need you to stop being a passive observer and start thinking like a strategist. I'm not telling you this to scare you. Fear is useless. Panic is expensive. I am telling you this so you can see the board. If you understand that the system must debase the currency to survive, if you understand that the debt cannot be paid back in real terms, then you realize that holding large amounts of fiat currency, cash, is a guaranteed losing strategy over the long term. It is a melting ice cube. The government is essentially playing a game of musical chairs. The music is playing faster and faster. The chairs, which represent real value, are getting fewer and fewer. When the music stops, when the next crisis hits, when the next massive round of printing begins, you do not want to be the one holding the paper. You want to be the one sitting in the chair. So, is this a trap or is it an opportunity? It is the greatest trap in human history for the uninformed. For the person who keeps their savings in a low-interest bank account, who believes the CPI numbers on the news, who trusts that the government will fix it, it is a trap. They will be the liquidity that the system drains to keep itself alive. Their purchasing power will be transferred to the state and to the asset holders. But for the informed, for the Economy Decoded community, this is the greatest wealth transfer opportunity of our lifetimes. Because once you accept that the dollar is going to lose value intentionally, systematically, you stop saving in dollars. You start using dollars as a tool to acquire things that cannot be printed. This brings us to the core philosophy of our solution. Loyalty to the asset, not the currency. We talk a lot about loyalty on this channel. Usually it's about brand loyalty or customer loyalty. But in the macro sense, you need to ask yourself, what are you loyal to? Are you loyal to a piece of paper with a dead president on it? Or are you loyal to the value that your hard work created? If you are loyal to your value, you need to move it into vessels that do not leak. This is where we have to differentiate between financial assets and hard assets. Financial assets are someone else's liability. A bond is a debt someone owes you. A bank deposit is an IOU from the bank. If the counterparty fails, or if the currency they owe you in becomes worthless, you lose. Hard assets are different. They are nobody's liability. Gold, silver, farmland, energy, commodities, Bitcoin. These are things that require energy and effort to produce. You cannot print a barrel of oil. You cannot print an ounce of gold. You cannot print a sprawling acre of fertile soil. Their supply is constrained by physics, not by policy. Look at the chart of gold versus the US dollar since 1971. It is not that gold has become more expensive. An ounce of gold is still just an ounce of gold. It buys roughly the same amount of bread, the same amount of high-quality suits as it did 100 years ago. What you're seeing on that chart is not the rise of gold. It is the fall of the dollar. It is the mirror image of the debt spiral we talked about in part 1. The solution begins with a mindset shift. You have to stop measuring your wealth in dollars. If your house went up in value by 20%, but the money supply increased by 20%, did you get richer? No, you stayed the same. The numbers just got bigger. The money illusion tricks you into feeling wealthy while your actual purchasing power stagnates. To break free from the illusion, you have to become your own central bank. You have to look at your personal balance sheet. If you are heavy in cash, you are short the market and long the government's competence. That is a risky bet. If you are heavy in fixed income bonds, you are betting that inflation will come down and stay down, despite the fact that the government needs inflation to pay its bills. That is a risky bet. The smart money, and the whales we talked about earlier, they are quietly accumulating the finite. They are buying the land. They are buying the mines. They are buying the infrastructure. They are front-running the inevitable debasement. But you don't need billions to do this. You just need to understand the principle of scarcity. Let's get specific. What does a loyalty builder portfolio look like in a debt spiral world? It isn't about reckless gambling on meme stocks. It is about defensive positioning. It starts with the foundation. Insurance, gold, and silver. I want you to stop thinking of precious metals as investments. An investment is something you buy to get rich. You buy a tech stock to get rich. You buy a lottery ticket to get rich. Gold is not that. Gold is insurance. Think about your car insurance. You don't pay your premium every month hoping that you get into a wreck so you can cash out. That would be insane. You pay it so that if the worst happens, you're not wiped out. You pay it to sleep at night. Gold and silver are fire insurance for your purchasing power. For 5,000 years, through the rise and fall of Rome, the Spanish Empire, the British Empire, gold has never gone to zero, not once. Fiat currencies go to zero all the time. The graveyard of paper money is vast, but gold remains. And here is the tell. Watch what the central banks are doing, not what they are saying. While Western governments tell you that gold is a barbarous relic or old-fashioned, central banks around the world, especially in the East, have been buying gold at the fastest pace on record since 2022. They are trading their dollars for bullion. They are moving from trust me assets to show me assets. If the people who print the money are hedging against their own product, shouldn't you? But you cannot eat gold. And it doesn't pay dividends. So insurance is just the foundation. The next layer of your loyalty strategy must be productive assets with pricing power. This is critical. In an inflationary environment, which is what a debt spiral eventually creates, prices go up. The price of bread, gas, housing, and services rises. If you own cash, you lose. You get poorer. But if you own the companies that produce the bread, the gas, and the housing, you win. You want to own businesses that have pricing power. This means they can raise their prices to match inflation, and customers will still pay. Think of the brands you are loyal to, the essential services, energy companies, consumer staples, healthcare. If the dollar loses half its value and the price of a product doubles, the company's revenue doubles. The stock price, in nominal terms, tends to follow. You are effectively surfing the inflation wave rather than drowning in it. You are moving from being a victim of the spiral to a beneficiary of it. And then there is the most controversial, yet potentially most powerful tool in the modern arsenal: digital scarcity, Bitcoin. I know, it's volatile, it crashes, it scares people. But step back and look at the macro thesis. If the problem is that the government can print an infinite amount of dollars, then the solution must be something that cannot be printed. There will never be more than 21 million Bitcoin. It is a mathematical cap. It is the only asset in the known universe with a perfectly inelastic supply schedule. When the price of gold goes up, miners dig more and the supply increases. When the price of real estate goes up, developers build more condos. When the price of Bitcoin goes up, the supply schedule does not change. Wall Street fought it for a decade. Now, BlackRock, Fidelity, the biggest pension funds, they are all building the infrastructure to hold it. They recognize it as digital gold. It is an asymmetric bet on the failure of fiat currency. You don't need to put your life savings into it, but having zero exposure to the only asset class that is mathematically designed to counter currency debasement, that is a risk in itself. Finally, we have to talk about the asset that isn't on a balance sheet. It isn't in a brokerage account. It is you. In a world where capital is being debased, the ability to create value becomes the ultimate currency. Skills, adaptability, relationships. This is Economy Decoded philosophy. Financial loyalty is important, but human loyalty is the bedrock. Who can you trust? Who is in your network? If the banking system takes a holiday, or if the grid goes dark, or if supply chains fracture, your net worth is not a number on a screen. Your net worth is your community. Your net worth is your ability to solve problems for other people. Invest in your skills, invest in your health, invest in your local resilience. These are the things that inflation cannot erode. A skill you master today is a revenue stream you own forever. No government can tax it away until you execute it. No bank can freeze it. It is yours. So let's bring this all back to the start. The hook, the panic, the news. The headlines are going to get worse. The debt number is going to hit 40 trillion, then 45, then 50. The interest payments will consume 20%, then 25% of tax revenue. The politicians will scream at each other, blaming the other side, while voting unanimously to raise the debt ceiling again and again. They have no choice. The math is in charge now. You can look at this data, the 970 billion in interest, the foreign dumping, the spiral, and you can choose to be paralyzed by it. You can choose to be angry. You can post on social media about how unfair it is. Or you can accept the reality of the board. The system is doing exactly what it was designed to do. Inflate away the debt at the expense of the currency holders. It is a slow motion default. It is a trap for the passive. It is an opportunity for the prepared. By diversifying out of the dollar, by owning hard assets, by building a loyalty portfolio of insurance, productive businesses, and digital scarcity, you are essentially building an ark. You are acknowledging that the rain is coming, and you are choosing not to drown. The debt death spiral is not the end of the world. It is simply the end of an era, the end of the easy money era, and the beginning of the hard value era. The transition will be turbulent. It will be messy. It will confuse the experts who are still looking at models from 1990. But for you, you have the ledger, you have the history, you have the data. You know that when the debt becomes unpayable, the money changes. Don't wait for the official announcement. By the time they admit there is a crisis, the doors will be closed. The capital controls will be in place. The prices of hard assets will have already doubled. The time to build your position is when the room is quiet. The room is still relatively quiet, but if you listen closely, you can hear the ice cracking. Make your move. So here's the bottom line. The United States is borrowing $1 trillion every 9 months just to keep the lights on, while our biggest foreign creditors are walking away from the table. The math guarantees that the dollar must be devalued to keep the system from collapsing, meaning your savings are the fuel for the fire. I want to ask you one question. If the dollar loses another 50% of its purchasing power in the next decade, what do you own that will survive? If you want to survive the transition, hit that subscribe button and turn on notifications. We're going to be tracking every trillion, every policy shift, and every opportunity right here on Economy Decoded. Stay liquid, stay loyal, and I'll see you in the next one. Disclaimer. The content presented in this video is for informational and educational purposes only and does not constitute financial, investment, legal, or tax advice. I'm not a financial advisor. The economic data, historical trends, and market analysis discussed are based on research and personal opinion. All investment strategies involve risk of loss. You should conduct your own due diligence and consult with a qualified professional financial advisor before making any investment decisions. Past performance is not indicative of future results.